All right, welcome back to the Explainer from TalkTickers. Today, we are digging into a real Wall Street paradox. You've got Fabrinet, right? They just dropped an absolutely stellar earnings report for their fourth quarter of fiscal 2025. But, and this is the weird part, the market's reaction? Well, let's just say it wasn't a party. So, let's jump right in.
And here it is. This is the heart of the whole puzzle. I mean, look at this. On one side, you've got these incredible, record-breaking numbers, the kind of report that should have investors popping champagne, right? But then, on the other side, you see the reality, a really painful 10% haircut in after-hours trading. So, what gives?
So in Wall Street lingo, this is what's known as a beat and a drop. It's pretty straightforward. The company beats all the expectations, but the stock, it drops anyway. And our job right now is to get to the bottom of why.
I mean, think about it. Why on earth would investors stampede for the exits right after getting what looks like amazing news? Well, the answer isn't just about the numbers they reported. It's all about what the market was hearing between the lines.
Okay, so before we get into the problems, we really have to wrap our heads around just how strong this quarter actually was. Because make no mistake, by pretty much every metric, Fabrinet's performance was absolutely exceptional.
So let's start at the top with revenue. They pulled in a record $909.7 million for Q4. Now, to put that in perspective, that's almost a 21% jump year over year. And it was a solid beat over what the analysts were expecting. I mean, that is a seriously impressive number. And you know what? The story gets even better when you look at the bottom line. Their non-GAAP earnings per share, which is basically a key measure of their profitability, hit an all-time high of $2.65. And yep, you guessed it, that also crushed what Wall Street was expecting. So you've got record revenue and record earnings. That's the dream combo right there.
Now, if we pull back and look at the entire fiscal year, the picture is just as impressive. The CEO, Seamus Grady, he called it an outstanding year, and honestly, the numbers totally back him up. We're talking a record $3.4 billion in revenue. That's up 19% and an all-time high for earnings per share. Oh, and on top of all that, they just locked in a massive new partnership with Amazon Web Services. Things were looking good.
But here's where we start to see a potential crack. Take a look at their customer breakdown. Just two companies, NVIDIA and Cisco, make up nearly half of their entire revenue. And get this, their top 10 customers, that's 86% of their business. This is a really, really crucial detail, and it's a huge hint at one of the underlying risks we're going to talk about in a minute.
All right, so the past performance was, fantastic. But any investor worth their salt will tell you the market doesn't care about what you did yesterday. It's all about what you're going to do tomorrow. And it was in the company's guidance, their look into the future, where those cracks really started to show.
And what's funny is, on the surface, the guidance for the next quarter looks pretty great, too. They're guiding for revenue to grow again and for earnings to go even higher. That's a classic beat and raise. So you're probably asking, what's the problem here? Well, as they say, the devil is always in the details.
And there it is. That's the quote straight from the CEO himself. A surge in demand. I mean, that should be a great thing, right? But he says it's creating temporary component supply challenges. For anyone listening on that earnings call, that phrase right there was the first major red flag. Okay, so let's unpack what this supply issue really means. Fabrinet is seeing this massive spike in demand for their super high-tech, next-gen 1.6 terabit products. Awesome, right? The problem is they physically cannot get their hands on enough of a really critical laser component. So what's the result? Management had to admit that they expect a dip in their datacom revenue next quarter, even while demand is going through the roof. See the problem? Then there was the second big concern, cash flow. Now, their operating cash flow was solid, came in at $55 million. But, and this is a big but, look at their capital expenditures, or CAPEX. That's the money they're spending on big projects. They spent a whopping $50 million, mostly on a huge new facility. So you do the math, that left them with only $5 million in free cash flow. And that kind of steep drop, yeah, that definitely got the market's attention.
And all of this brings us right back to that big disconnect. We had a fantastic report, what we analysts call a constructive print.
But at the same time, we had a really negative reaction from the market, or what we'd call a cautious tape. So let's decode exactly what that means.
So, just so we're all on the same page here, constructive print, cautious tape is just a bit of Wall Street slang for exactly this scenario. The print refers to the earnings numbers printed on the page, and they were good or constructive. But the tape, you know, the old school stock ticker tape, was cautious, and the stock price moved lower. Simple as that.
So the big question is, why all the caution? Why did these issues with the supply chain and cash flow completely overshadow what were honestly record-breaking results? Well, it really boils down to a couple of key concerns.
So here are the three biggies. First, you've got near-term execution risk. The big question is, can management really fix these supply problems in just 1 or 2 quarters like they say they can? Second, that really low free cash flow. Yeah, it's for future growth, but right now, today, it makes the company look a lot less profitable. And third, and this one is huge, the stock had already gone on an absolutely massive run.
And this chart right here shows you exactly why that third point matters so much. Look at this. In the year leading up to this report, Fabrinet stock was up over 41%. That's more than double what the rest of the tech sector did. The bottom line is, the stock was already priced for perfection, so any little hint of a problem, like a supply issue, was all it took to send people running.
Okay, so how can we take all this analysis and turn it into an actual actionable idea? Well, at TalkTickers, this is what we call the next call. Here's our take. We're calling this speculative trade idea the supply chain sprint. And it's pretty simple, really. It's a bet that the market has completely overreacted to what management keeps insisting is just a temporary problem. The whole thesis here is pretty simple. You are making a wager on management's ability to get things done. If they can solve these supply issues quickly, then that dip in Datacom revenue for Q1, it'll just be a tiny blip on the radar, and the stock could come roaring back. Now, one way to play this is with an option strategy, something like a bullish call spread with maybe a 3 or 4 month expiration. That's a way to define your risk so you know exactly what you could lose, while still capturing that potential upside if they actually pull it off. So, let's put it all together. After this, well, this pretty wild quarter, what's our official rating and outlook for Fabrinet? We are officially rating Fabrinet as outperform, and here's why. We believe the long-term story here is still completely intact. It's driven by AI, by that huge new AWS partnership. Those things haven't gone away. So our outlook is that once these temporary supply problems are sorted out and their new high-performance computing business really starts to ramp up, you're going to see revenue growth kick back into high gear in the second quarter. And if management can prove they've got this under control, we absolutely see the stock having the potential to retest its old highs after this dip. So at the end of the day, Fabrinet is just a fascinating case study. You've got a really great company hitting a pretty significant speed bump right at the exact moment that expectations were at a fever pitch. And that leaves every investor with a really critical question. Is this dip a major warning sign, or is it a golden buying opportunity? Now remember, this is not financial advice. Investing always involves risk, and you should always consult with a professional.